Welcome to the deep dive. We basically cut through the noise for you.
Right.
Forget spending hours digging through information. We take the sources you care about today, that's Michael Lewis's The Big Short, and we pull out the core ideas, the surprising bits.
And hopefully make it all make sense. Maybe even find some aha moments along the way. We're doing this for you, the learner, someone who wants to get up to speed quickly, see different angles.
Exactly. Without getting buried in jargon.
So today's mission with The Big Short isn't just, retelling the story of the 2008 crisis.
No, we want to get underneath that.
We're digging into how it happened, the thinking of the people who saw it coming, and importantly, what lessons are still relevant for you today.
What can you actually do with this information? That's the key.
Okay.
Okay, so let's jump in. Michael Lewis, he wrote Liar's Poker way back, right?
Oh.
About Wall Street in the 80s.
He did, yeah. Focused on the bond market then. And what's really interesting is he thought that book was capturing like a specific moment of madness.
A kind of historical artifact.
Pretty much. He actually says he thought it was a period piece about the 1980s when a great nation lost its financial mind.
Wow.
The shock for him, coming back to it years later for The Big Short, was that the craziness hadn't stopped. It had morphed, gotten bigger, much bigger.
So the excesses just grew, not a one-off thing.
Not at all. It really tells you something about how these bubbles can just keep inflating even after people start pointing fingers.
Like ignoring a crack in the wall until the whole thing comes down. Okay, speaking of pointing fingers, Meredith Whitney. She wasn't exactly a Wall Street titan, but her call on Citigroup in 2007, huge waves.
Yeah, that was pivotal. What made her stand out was her focus. She zeroed in on what she bluntly called crappy assets.
Right, the toxic mortgage stuff.
Exactly. On Halloween 2007, she basically went public saying Citigroup was so loaded with these mismanaged assets they might have to slash their dividend, or worse.
Wow.
Lewis quotes her. On that day, she predicted that Citigroup had so mismanaged its affairs that it would need to slash its dividend or go bust. The market reaction. Immediate. Brutal.
And it shows how someone from maybe slightly outside the core groupthink can see things clearly.
Absolutely. And it wasn't just about fraud, necessarily.
Yeah, you mentioned that Lewis quoted her suggesting they might just be clueless.
Right. Her point, as Lewis put it, was basically these people whose job it was to allocate capital apparently didn't even know how to manage their own. It really makes you think, doesn't it?
It does. How well do any of us really grasp the systems we're in? Our jobs, our finances.
Yeah. Gig titles don't always mean deep understanding.
Okay, let's talk about the folks who did see it coming. Contrarians. Steve Eisman. Sounds like quite a character.
Oh, definitely. Lewis paints him as just fundamentally skeptical, always looking for the flaw, the contradiction.
His mother had that theory, right? About his two personalities.
Yeah, the sort of careless, generous giver and then the intense guy searching for internal contradictions. It's quite revealing.
So that skepticism drove him.
Seems like it. That need to dig under the surface probably made him see the cracks in the system others just glossed over, even if he came across as, a bit abrasive sometimes.
Abrasive, but maybe necessary. And he ended up focusing on subprime mortgages. What set off his alarm bells there?
Well, with normal mortgages, the worry was always people paying them off too soon. Investors lose out on interest.
Right, prepayment risk.
Exactly.
Yeah.
But with subprime loans to people with shaky credit, the risk flipped completely. It became about no repayment at all.
Ah.
Lewis explains how the bond structure tried to deal with this. They created tranches, like layers. If homeowners defaulted, the bottom tranches took the first hit.
Sort of like a buffer.
Supposedly. But Eisman saw that these loans were just inherently way, way riskier, and the complexity was hiding that fact.
So packaging up bad debt to make it look good, and the whole originate and sell model fed into this.
Massively. Cy Jacobs, an analyst in the book, nailed the problem with originate and sell. The idea sounded okay. Banks make loans, sell them off, free up capital to make more loans, maybe even helps people get houses.
Sounds good on paper.
But, as Jacobs said, any business where you can sell a product and make money without having to worry how the product performs is going to attract sleazy people.
The incentives were all wrong.
Completely. If you're not holding the risk, why worry too much about the quality of the loan? It's a huge lesson. Always look at who benefits and who pays the price.
A system just asking for trouble. And Eisman's team. It came together unconventionally. Something about a personal tragedy.
Yeah, Vinnie Daniels' hiring was kind of random, showing Eisman's gut instinct approach. But the bigger thing was the loss of Eisman's infant son, Max.
Oh, wow.
His wife Valerie said after Max, the angel on his shoulder was done, Anything can happen to anyone at any time. Lewis suggests this tragedy maybe amplified Eisman's sense of fragility, his skepticism about everything, including finance, made him more willing to believe disaster was possible.
That's heavy. But it shaped his worldview.
It seems so. And his fund attracted people who shared that, let's call it a shaded view. Vinny, Porter Collins, Danny Moses.
Danny Moses, the salesman guy?
Yeah, he was deeply cynical about Wall Street motives. Famously asked someone who got him into a great trade, "How are you gonna fuck me?"
Huh. Direct again.
It wasn't just being paranoid, it was recognizing the potential for hidden agendas. Their shared feeling that things often aren't as good as they seem. That was key.
A healthy dose of skepticism in the team. And as this originate and sell thing exploded, the big banks jumped in, creating these, weirdly named products.
Oh, yeah. Heat Sale, G. Sampe, obscure names for these subprime bond shelves from Bear Stearns, Merrill, Goldman, Morgan Stanley. It kind of hid who was really behind them.
And Eisman was suspicious from the start.
He'd been burned before in an earlier subprime wave. His takeaway, as he put it, what I learned was that Wall Street didn't give a shit what it sold. His core belief was they were just driven by the deal flow, the profits, not the quality or the consequences. Turned out he was pretty much right.
So shaky foundations, twisted incentives, a disaster waiting to happen. Okay, let's switch gears to Michael Burry. Another outsider, saw it coming, but from a different angle. What made him tick?
Burry was unique. Lewis talks about his childhood cancer, losing an eye. It literally gave him a different perspective. Social interactions were tough. He was very literal.
Asperger's, right. Diagnosed later.
Yes. And that outsider view, combined with this intense focus on logic, fairness, deep research, that shaped everything. He wasn't swayed by hype. He did the work.
A true independent thinker. And Scion Capital, his fund, reflected that.
Totally. He made his name digging into financial statements, finding value others missed. He wasn't following trends. Lewis mentions his focus on incentives, like Charlie Munger's ideas.
Look at the incentives to understand the behavior.
Exactly. And Burry structured his own fees, so he only made money if his investors did. As Lewis said, to make the first nickel for himself, he had to make investors' money grow. That fundamental analysis, that focus on incentives, it led him to see the housing market wasn't invincible. It was a bubble.
Okay, so he spots the flaws in subprime and figures out how to bet against it using credit default swaps. Can you break that down simply? What's a CDS?
Think of it like insurance. You own a bond, worry the issuer won't pay you back. You buy a CDS. If they default, the CDS seller pays you.
Okay, simple enough.
Burry's big idea was you could buy this insurance, the CDS, on subprime mortgage bonds even if you didn't own the bonds. You're just betting they'll fail.
Ah, so a pure bet, not hedging something you own.
Right. CDS existed for corporate bonds, but applying it to these mortgage bonds, that was new. That was his way in.
And this was happening just as these instruments were getting standardized. The ISDA.
Yeah, the International Swaps and Derivatives Association. They were creating the rule book, the common language for these swaps, made them easier to trade. They had rules for corporate CDS, but adapting them for complex mortgage bonds was a big step. It paved the way for Burry and, well, for the chaos that followed.
So Burry makes this huge, unconventional bet. How did his investors react? They were used to him picking stocks, right?
Yeah, there was definitely pushback. Lewis describes how they just didn't get it. Why was this brilliant stock picker suddenly obsessed with mortgages?
They wanted the old Burry back.
Pretty much. And Burry found it really frustrating. He said, I hated discussing ideas with investors because I then become a defender of the idea, which ironically makes it harder to change your mind if you need to.
That's a great point, getting locked into defending your position. But Wall Street did start paying attention to Burry's bet.
Some did. Greg Lippmann at Deutsche Bank was early. Then Goldman, BofA, Morgan Stanley started sniffing around.
Why this sudden interest?
Lewis hints at the obvious reason. The loans were starting to go bad. Fast. Burry's seemingly crazy bet was starting to look disturbingly plausible.
Reality catching up. And Lippmann had this unusual presentation style with his Chinese quant.
Eugene Zhu. Yeah, Lippmann used him, maybe somewhat theatrically, to add this air of pure objective data. The idea was you just crunched numbers, didn't speak English, so how could he be biased?
How can a guy who can't speak English lie?
Exactly. It played on the perception of objective math, even if the underlying assumptions were, debatable.
All about the narrative. Okay, now we get into the really brain-bending stuff. Synthetic CDOs. What were these things, simply put?
Yeah.
And how do they crank up the risk?
Okay, so you take those mortgage bond tranches. A regular CDO bundles those up, A synthetic CDO. It's not based on the actual bonds, it's based on credit default swaps on those bonds.
So bets on the bets.
Pretty much. Your layers removed from the actual mortgages. And the terrifying part, you could create way more synthetic CDOs than there were underlying bonds. Lewis gives the example. Goldman didn't need $50 billion in loans to create $1 billion in triple B bonds synthetically. They just needed someone like Burry to buy CDS on $1 billion worth of existing bonds.
Wow.
It completely decoupled the size of the bet from reality, like letting infinite people bet on just a few horses in a race. The potential losses, astronomical.
Just multiplying the risk
Yeah.
over and over. And Goldman used this with AIG, the insurance giant.
Yeah, Goldman sold huge amounts of CDS protection to AIG, meaning AIG was on the hook if the referenced bonds defaulted. Goldman got insurance, AIG got payments, as long as everything held up. Huge bets between giant firms.
And Lippmann himself at Deutsche Bank was shorting these things, even while his bank was selling them.
It's tricky. Different desks at big banks can have opposite views. Lippmann became convinced the whole CDO market was toast and took a short position within Deutsche Bank. Not necessarily a conflict, but it shows even insiders were seeing the danger. He believed in his analysis.
And he needed arguments to sell his short idea to get people to buy the insurance he was offering.
Right. He used Eugene Jou's analysis heavily charts, showing how even small drops in house prices could trigger massive defaults, making the CDS valuable. That data-driven pitch was his angle.
So this CDO machine, Goldman could basically conjure up $1 billion in highly rated bonds without needing $1 billion in actual mortgages.
How? Synthetics again. Buy CDS on existing BBB bonds, package those CDS references into a new synthetic CDO, take that to the rating agency.
Who would then give it a high rating?
Often, yes, using models the banks themselves had influenced. So junk bonds, referenced by swaps, magically become AAA synthetic CDOs. The link to real loans gets thinner and thinner.
And the rating agencies, they were enabling this, giving these things their blessing.
Lewis portrays a very cozy relationship. Banks would basically workshop their CDO structures with the agencies. Ask, how does this look?
Seriously.
And the agencies paid fees by the banks for rating this stuff, often relied heavily on the bank's own numbers. So yeah, risky BBB stuff got repackaged and stamped AAA, opened it up to pension funds, everyone who needed safe assets. Big conflict of interest.
So the synthetic market basically blew the lid off any connection between the size of the risk and the actual number of bad loans.
Totally decoupled it. You didn't need more bad mortgages, just more people willing to trade the swaps inside these synthetics, amplified the potential losses exponentially.
And Lippmann even tried to get AIG to stop buying this supposedly safe AAA stuff. Why?
He knew AIG was the big counterparty, the main buyer holding the bag on these AAA CDO swaps. If they stopped buying, realizing it was often just repackaged junk, the whole house of cards could collapse. Prices would plummet. His own short positions would pay off massively.
Even if his own firm was involved, driven by his own thesis.
Exactly. Which leads us to Joe Cassano at AIG FP. His management style. Not great for risk assessment, apparently. Lewis paints Cassano as someone who demanded total loyalty, didn't really grasp the complex risks, and shut down any bad news or dissent about AIG's subprime exposure.
That sounds dangerous.
Extremely. Lewis shares stories of him needing to be right, dismissing concerns, created a culture where no one dared challenge the narrative, even as the risks piled up sky high. Hubris in leadership, you know?
Yeah, a classic case of culture blinding a company. The gap between his view of risk and AIG's actual exposure was huge.
Staggering. Even as the subprime market was visibly cracking, Cassano seemed convinced AIG was fine. Maybe didn't understand the complexity, maybe just didn't want to. It led straight to their near collapse and the bailout.
So with the market cracking, Lippmann started pitching his CDS to stock investors, hedging housing exposure.
Yeah, he figured the bond guys were too dug in. So he went to stock investors holding shares in home builders, lenders, anyone tied to housing. Pitched the CDS as insurance for their stock profits. A hedge against a housing downturn. Different angle, different audience.
And he nearly got Front Point Partners involved, but misunderstood their setup.
Right. He thought Front Point was one big fund heavily invested in New Century, a subprime lender. But Front Point was more like an umbrella for multiple funds. The one long New Century was actually pretty small relative to the whole firm. His hedge pitch didn't quite land as intended. Need to know your audience, I guess.
Meanwhile, S&P announces changes to their rating model, and banks rush to issue more bonds under the old rules. That's backwards.
Totally perverse incentive, right. S&P says in May 06, the rules get tougher in July. So what happens? Banks flood the market before July, trying to get their stuff rated under the old, easier model. Vinny called it stuffing the channel, getting the shit out quick.
Wow. Even attempts at regulation backfired.
And get this. Even with tougher standards coming, even with house prices starting to wobble, the cost of insuring subprime bonds went down for a while.
How's that possible? Makes
Eh,
no sense.
Baffling. Shows how detached from reality the market was. Widespread denial, total mispricing of risk. Markets aren't always rational, especially in a bubble.
Around then, Eisman's team finally connects with Flipman. Starts getting his emails.
Yep. They finally did their first trade with him, got on his infamous email list. Constant stream of bearish data, arguments reinforcing their own view. Didn't replace their own analysis, but definitely valuable intel.
And while Burry was deep in the math, Eisman's guys were doing ground-level stuff, visiting neighborhoods.
Yeah, very different approaches. Eisman's team dug into who was borrowing, who was lending, checked default rates state by state, credit scores.
Yeah.
They went to Miami, saw the empty houses in subprime-fueled developments firsthand.
Boots on the ground.
Found huge differences in defaults between states, suggesting it wasn't just the economy but the quality of the loans themselves, a stark contrast to the abstract Wall Street models.
Really shows you need both, right? The math and the real world. Okay, let's bring in Cornwall Capital. Charlie Ledley, Ben Hockett, Jamie Mai. Small outfit, different style, but they also saw the opportunity. What was their first reaction to Lipman?
Cornwall operated by looking for mispriced stuff, often in weird corners. Ledley's reaction to Lipman's pitch was basically disbelief. Why isn't someone smarter than us doing this?
Humble, at least.
Yeah, show them they weren't experts in this specific complex area. Also shows how strong the housing is solid belief was.
And Charlie noticed this parochialism in finance. People stuck in their silos.
Yeah, he felt experts were too focused on their little patch, U.S. stocks, European bonds, whatever. No one was connecting the dots globally. How a problem in U.S. subprime could wreck everything. Need that big picture view.
Cornwall's work on Capital One led them to LEP, long-term options. How did that fit in?
They were digging into Capital One, read Joel Greenblatt's book, You Can Be a Stock Market Genius, which talked about LAPs. It sparked an idea. Maybe use options to bet against subprime stuff. Leverage their bet. Limit their downside if they were wrong on timing. Thinking outside the box.
And Ben Hockett joins them from Deutsche Bank Tokyo, bringing in a different vibe.
Right. Ben had this broader sense of real-world risk disasters, system failures, not just finance. He saw Charlie and Jamie as maybe more flight-focused on their own risk. Ben was thinking bigger picture. He even sold his own house based on a rent valuation rule, worried about a wider downturn. That mix of perspectives helped them.
So Cornwall debates Lipman's trade. They see the CDS as cheap insurance on a likely disaster. What clicked?
They saw the asymmetry, the cost to insure the triple B slice of subprime bonds, so low compared to the chance of default, like buying cheap fire insurance on a smoldering house. Who was selling it so cheap? That led them to CDOs.
And all the confusing jargon, ABS, RMBS, HELOC, they saw that as deliberate.
Deeply suspicious. All these acronyms just obscured the basic fact. These were risky loans to people with bad credit. They figured the jargon was intentional, make it sound complicated, less risky. A lesson there. Beware complexity, especially when money is involved.
Their big insight was about CDOs made of those triple B bonds. Even a few defaults could wipe them out, despite high ratings.
Yeah, they realized these CDOs weren't truly diversified. All the underlying mortgages were vulnerable to the same things, rate hikes, price drops.
Yeah.
A small percentage of defaults could cascade through and vaporize the lower tranches, even in highly rated CDOs heavily reliant on those tranches. Charlie's conclusion. That's just fucking crazy. That's fraud.
Whoa. So instead of betting on the riskiest stuff, they bet on the AA tranche of CDOs. Why?
Strategic genius, really. They figured the ratings were meaningless anyway. CDS on AA CDO tranches were priced way cheaper than on BBB bonds, but they were exposed to the same underlying garbage mortgages. It was a cheaper, smarter way to make the same bet against the whole system.
Find the inefficiency.
Mm-hmm.
And they checked their logic with an expert, David Bird, realizing they might be the first ones doing this exact trade.
Yeah, they wanted a sanity check. Burt couldn't find a flaw in their thinking and suggested they were possibly the first buying CDS on AA CDO tranches, both validating and kind of terrifying for them. Shows how far ahead they were.
Which brings us to that surreal subprime conference in Las Vegas. The setting sounds wild.
Oh, totally. Glitz and gambling while the financial world was secretly crumbling. Perfect metaphor for the whole disconnect.
And Eisman shows up to golf in
Mm.
gym shorts.
Yep. Gym shorts, t-shirt, sneakers, didn't care about the fancy club rules. And his golf game, same attitude. Ignored rules, selective memory about his shots. Vinny said he had no scars from prior experience because of that memory. Fearless, maybe. Definitely unconventional.
It was a dinner there with Wing Chao, a CDO manager, that Eisman had his big engine of doom realization about mezzanine CDOs.
That was huge. Chow managed billions in these mezzanine CDOs, basically stuffed with the risky triple B mortgage bond slices. He was creating artificial demand for the worst stuff.
And Chao wasn't worried.
Worried, he told Eisman, I love guys like you who short my market. Without you, I don't have anything to buy.
Get out. Seriously.
Seriously, showed the whole insane feedback loop. Shorts created demand for the CDS, which allowed more CDOs to be built from the swaps, fueling the machine Chow ran, completely detached from the actual loan quality. Blew Eisman's mind.
Mine too. Just, wow.
Yeah.
Then John Devaney goes on this rant at the conference. What was that about?
Devaney, another subprime insider, just kind of let loose, spoke very frankly about how worthless the securities were, how complicit the rating agencies were. Confirmed everything Cornwall Capital suspected.
Must have validated them.
It did, but it also spooked them. If insiders were saying this stuff out loud, maybe the party was ending fast. They accelerated their trades.
Cornwall then had trouble finding banks to trade with, but Morgan Stanley, through David Burt, eventually did.
Yeah, being small and unknown wasn't easy, but persistence and Burt's credibility got them in the door with Stacey Strauss at Morgan Stanley. Shows that even in big, rigid systems, a good argument can sometimes find an opening.
Eisman, meanwhile, confronts a subprime CEO with his fingers.
Classic Eisman. CEO claims a low 5% default probability. Eisman just holds up his fingers, 0, then walks out to take a fake phone call. Utter contempt for the BS.
He wasn't subtle. It was in the Vegas casino madness that Eisman really grasped the scale of the delusion.
Yeah, surrounded by all these optimistic conference goers, the sheer denial hit him. Danny Moses was like, who the fuck are all these people? Eisman started questioning if he was the crazy one, then shifted into just trying to learn, understand the full scope of it.
And his chats with the rating agencies there didn't help.
Made it worse. Found them timid, focused on deal volume and fees, just repeating the 5% losses party line, convinced him they were clueless or complicit, reinforced his view the whole system was rigged.
Back home, Cornwall sees a Bear Stearns report way off on the cost of insuring AA CDOs.
Yeah, Charlie saw this analyst report pricing the insurance way, way lower than what it was actually trading at. Just highlighted the disconnect, the bad analysis, maybe deliberate misinformation coming from Wall Street, made Cornwall even more confident in their bet.
And the most baffling thing, Merrill Lynch, Citigroup, still churning out billions in new CDOs between Feb and June '07, while the market's clearly tanking.
Astonishing, isn't it? Just shows the inertia, the addiction to the fees. The machine had to keep running, even driving off a cliff. Willful blindness, maybe?
While Baer and Lehman kept publishing happy research, and Moody's and S&P dragged their feet on downgrades.
Exactly. The optimistic noise and the slow ratings response just kept the illusion going longer, allowed more toxic stuff to get sold, made the eventual crash even worse. Needed timely, accurate risk assessment, and didn't get it.
Eisman's loading up on shorts, but getting pushback from his own firm's risk managers.
Yeah, he wanted to go bigger, faster. But FrontPoint's risk guys got nervous about the sheer size of his bets. Potential downside if he was wrong, or just wrong on the timing, created friction. His team even started hiding bad news from him so he wouldn't try to bet even more.
Wow. The irony. Okay, those floating rate mortgages. The teaser rates resetting higher. The rating agencies totally misjudged that, didn't they?
Big time. They assumed borrowers could handle the payment shock when those low initial rates jumped. But many were stretched thin already. They underestimated how vulnerable people were, didn't model a scenario where everyone's rate resets upwards into a falling market. Fundamental error.
Then Bear Stearns subprime hedge funds blow up in June '07. That was the moment people realized even AAA wasn't safe.
Huge wake-up call. Those funds held tons of supposedly safe AAA CDOs backed by subprime. When they collapsed, it proved the rot went right to the top of the rating scale, shattered the illusion, fueled Eisman's view that Wall Street didn't even understand its own holdings.
And the complexity made it hard to know what was inside these things anyway.
Exactly. So opaque. Even the guys betting against them didn't always know the exact loans underneath. Hard to assess risk accurately. As Jim Grant said, built on obfuscation.
Burry, meanwhile. The market's finally moving his way, but he's still feeling isolated, battling his investors. His early warnings look prophetic now.
Yeah, it must have been incredibly frustrating. He'd called it back in '03 a crisis coming from dumb things institutions were doing. Now it's happening, but his investors are still impatient, distrustful. He's being proven right, but still fighting skepticism.
Which leads him to side pocket the CDS,
Uh,
lock up investor money. Drastic move.
Super drastic. Investors wanted out, but the CDS weren't easily sellable yet, and he knew their real value was huge, so he put them in a separate pocket, restricting withdrawals, protected the investment's potential, but really angered investors. Lewis quotes his defiant letter, shows that clash between long-term strategy and short-term demands.
Then June '07, bear funds collapse. Goldman seems to struggle valuing Burry's swaps. The beginning of the end is visible.
That was it. The bear funds proved the vulnerability. Goldman's issues showed the market seizing up. The crisis wasn't theoretical anymore. It was here.
And the teaser rates resetting, like in that OMLT pool Lewis mentions, that was the trigger for the default wave Burry predicted.
That was the fuse being lit. Rates jump, payments become impossible for millions, foreclosures spike. The whole house of cards starts to tremble.
While over at Morgan Stanley, Howie Hubler makes this enormous $16 billion bet on AAA subprime stuff.
How? Hubler's bet is just staggering, shows how deep the mispricing and misunderstanding went, even at top firms. The risk models were flawed, didn't account for a nationwide housing crash, relied on bad history. They thought AAA was basically free money.
And they missed that key difference between corporate loans and consumer mortgages.
Fatal flaw. Corporate loans diversify across industries. Mortgages. Everyone in a region suffers if the local economy tanks or house prices fall everywhere. The models just didn't capture that correlated risk for consumers. No precedent for a nationwide housing dive.
And traders arguing over tiny basis points on billion-dollar trades of this stuff just shows they thought risk was zero.
Unbelievable in retrospect. That focus on tiny price tweaks proves the conviction. These were safe. Dangerous complacency born from perceived safety.
Lippmann, though, was warning inside Deutsche Bank that AAA CDOs could go to zero.
He was one of a few loud internal voices saying the unthinkable, met with skepticism, of course. Going against the herd is tough, even when you're right.
And Hubler at Morgan Stanley, resisting stress tests with higher default rates. Just denial.
Textbook organizational denial. Didn't want to see results that challenged their core beliefs. The quote Lewis includes is chilling. They didn't want to show you the results. That state of the world can't happen. Blinding themselves to the cliff edge.
Lippmann then forces Morgan Stanley's hand on unwinding trades, makes them face the losses.
Yeah, as the market tanked, Lippmann got aggressive. Pushed Morgan Stanley hard to mark Hubler's positions to the collapsing reality, forced them to acknowledge the scale of the disaster.
Hubler's $9 billion loss. Biggest trading loss ever then. And he just quietly leaves.
A truly mind-boggling number underscored the sheer magnitude of the miscalculation. His quiet exit, a stark symbol of the human cost. The career's ruined.
And CEO John Mack blames an error in judgment, inadequate hedges. Kind of misses the bigger picture.
Seems like it. Focused on the mechanics, the hedging failure, rather than the fundamental system-wide mispricing of risk that enabled the whole thing. Easier to blame one error than admit the whole system was flawed.
Cornwall Capital, meanwhile, they won big. But their reaction was quiet, focused on protecting the win.
Yeah, extraordinary returns, but they didn't pop champagne. They immediately shifted to defense. How do we keep this money safe through the meltdown we know is coming? Smart risk management, know when to bank the win.
Ben Hockett trying to explain CDS on AA CDO tranches to his in-laws. Yeah, good luck with that. Shows the opacity.
Exactly. If even smart people outside finance couldn't grasp it, what hope did the average investor or regulator have? That complexity had so much risk.
By then, the scale of the coming losses was undeniable, right? The end was written.
Absolutely. Mid to late '07, it wasn't if anymore, just when and how bad. The dominoes were set up, the losses baked into the system, terrifyingly clear to those paying attention.
In September '08, Lehman, Merrill, AIG, the whole thing just explodes. The Doomsday Machine goes off.
Total meltdown. Lehman bankrupt, Merrill sold in a panic, AIG gets that massive government bailout, global markets just seized. Danny Moses said it, all hell was breaking loose. The interconnectedness meant one failure triggered others. Systemic collapse.
Cornwall focused on preserving wealth. Charlie Ledley even talks to a crisis historian, trying to understand the why.
Yeah. Having made their money, they focused on navigating the chaos. Charlie digging into the history, the systemic flaws, showed how deeply he'd grasped the underlying issues. Even surprised the historian.
And Valerie Eisman, noticing her husband changed after being proven right. Ego, then. Niceness.
Interesting insight, right? The psychological impact. Maybe an initial understandable ego boost, but then perhaps a deeper reflection on the human cost, a shift in perspective. Being right about something so devastating, it changes you.
The epilogue. Lewis reflecting on how quickly markets forget the failure to fix the core incentives on Wall Street.
Yeah, that's a key takeaway. Financial amnesia is real. Lewis's lunch with his old boss, Gutfreund, underlines that cyclical nature of boom, bust, and forgetting the lessons. The underlying drivers of risk-taking often don't get fixed.
And firms becoming black boxes, complex trading, dominating everything else.
Lewis saw that shift. Proprietary trading banks betting their own money becoming more important than serving clients or allocating capital made the system riskier, more detached from the real economy.
The government responds to the bailouts. Lewis highlights the lack of transparency, taxpayers taking on the bad debt.
Right. TARP and the bailouts aimed to stop total collapse, but they were opaque and ultimately transferred massive private losses onto the public balance sheet. Still debated today, necessary evil or moral hazard.
And he ends with that great metaphor, the deviled egg. Something for nothing. How's that connect?
It's perfect. The double egg looks appealing, maybe a bit fancy, but it's still just an egg. Like, those complex financial products, alluring, maybe profitable for a while, but often built on something fundamentally risky or worthless. That enduring appeal of getting something for nothing or hiding risk with complexity.
Okay, wrapping this deep dive on The Big Short.
Yeah.
What are the big, actionable takeaways for listeners, for you, the learner, in your own life?
Several huge ones, I think. First, be a contrarian thinker. Question the consensus. Do your own homework. Don't just follow the herd, whether it's investing, career choices, whatever.
Don't assume the experts always know best.
Exactly. Second, follow the incentives. Always ask, who benefits from this? How are people paid? Incentives drive behavior, often in unexpected ways. Understand them in any system you encounter.
Crucial. What else?
Third, beware complexity and opacity. If you can't understand it easily, be suspicious. Complexity often hides risk or bad deals. Demand clarity. Don't be intimidated by jargon.
Good advice for anything, really.
And finally, remember the human element. Bias, ego, fear, greed. They drive decisions way more than pure logic at all levels. Be aware of your own biases and consider others.
So connecting that to your life, when faced with a sure thing or something super complex, pause. Ask those questions. Understand the real story, the incentives. Don't just accept the surface narrative. Be skeptical, look deeper.
Absolutely. So here's a final thought for you. What are the deviled eggs around today? What looks appealing but might be hollow or risky? What widely held beliefs might be masking big vulnerabilities in finance or anywhere else? Keep digging, keep questioning.